Great. Now, from definition, we know that audit is about inspection or investigation of some materials or financial information, which we call in bracket subject matter. You need a subject matter. That is the thing that you are investigating. So it can be financial statement, it can be the system, but the most important thing is that you are investigating that particular subject matter so that you can come up with an opinion. And of course, it is done by an independent person. So audit is about examination of a subject matter by an independent person or a professional so that he can come up with a conclusion whether it represents true and fair position of the company, right? And in most cases, when you're doing investigation or audit of financial statement, your main aim is to check whether what you've been given by the management is really the position, is the true position of the company. Sometimes they might lie. So you ask yourself, whatever I'm seeing, is it the right thing that should be there, right? So that is what we mean by audit. And then you give a conclusion or opinion, right? So what are the stages in audit? Normally, we start by what is called engagement. Just like any other contract or any other job that you can get, you need to have a contract and sign. So we start with accepting or acceptance. So you can write here stages of audit. You accept engagement, acceptance of engagement. That's number one. Number two, after accepting the engagement, then you start now planning. You go back, you've been awarded the tender. Now you go back to your desk and start asking yourself, what do I need to go and do this particular work of audit? So that's what basically called planning. After planning, you now feel that you have the right resources, you have the right staffs who have the right skills. In terms of capacity and knowledge, you are okay. So you go back to the client and say, now we are ready to do the work. So you're going for what is called actual execution. Execution. Now, this is where now the actual performance of audit work happens. This is where I mean now to collect all the evidence that are possible. You perform all the audit tests that we'll be able to look at. Now you do what is called test of controls. Test of controls. And you perform what is called substantive tests, which we can look at that later. They are part of our syllabus. You need to check the internal controls, right? And of course, as an auditor, we know that if the internal control within the client business or the client activities, if they have weak internal controls, then we know that as an auditor, you are also risking because they can actually cause fraud and you end up giving a wrong conclusion. So here, you need to be very skeptical because of some matters. Number one is materiality and the errors that might appear. You ask yourself, in case the risk is there, how material can it be? How big? And what will be the impact? So we'll be able to look a lot. We'll look at this. And in this place, we have topic number 4. Topic 4 is really focusing on this area, which is called audit management. Audit management of practice or management of audit practice, topic number 4. We'll be able to look at that in detail, right? So after doing this, then now you collect evidence. After execution, you have evidence collection. After collecting evidence, because when you're doing all the tests and performing the audit procedures, those activities that you do so that you can get satisfied, we call them audit procedures. It is not a procedure that is step by step. It is not one by one. It is actually basically those little things that you're doing. If somebody is telling you to inspect here, check, verify, confirm, observe, those are the procedures, right? So there are things that you can easily see. That is through observation, like controls. If somebody telling you that here, when we are opening the bank branches, we are opening the door for the bank, we normally have one of we call them maybe the signatories, yeah, or the key holders. We have them getting in first. So as an auditor, if you're going to audit that particular area, you can check and observe that really what they're telling me is not what they are practicing. If they are telling you that they are good in customer service and they ensure controls are working, What are you seeing? So that is through observation. But then there are a lot of tests that you can do here. As you do any of these, you should be able to collect evidence and make a file. So under evidence collection, you need to have a file that shows what audit programs or procedures you performed. So you have evidence attached to support each. These evidence are very important because I normally tell my students, you cannot do an audit without evidence. You can't do an audit without evidence. You have to prove, just like lawyers. Everything that you do, you support, you table and say, this is what I have for it. Because at the end of the day, when you are presenting your report, the board directors might ask you, how sure are you? Did you confirm? What is the proof? So you need to have evidence that is there. So when you're looking at some of the elements of audit, which we are going to look at right now, one of them is evidence. Evidence must be there, right? Without evidence, you cannot even say anything. So that is it. Then of course, after evidence, you now go to the last step, that is report writing. Report writing. Report writing, then you give conclusion. So execution, I was saying, execution is when you're now performing the actual work. You say it's basically where you're now performing the actual work of audit. And it's a very important stage because that is where you need to do a lot of tests. One of the tests that obviously you'll start with as an auditor, the first test that you start with, when you go to client place, you ask yourself, how are the internal controls? Are the controls working? Because this one will tell you to what extent are you going to do the audit? What is going to be the scope? What is the magnitude of this work that you're going to perform? Because if the internal controls are not even there, they are not even working, just know that you have a lot to do. For you to come up with a correct opinion, you need to have a lot to do because there is higher risk. And then you look at the materiality of those errors that could be existing. So now that you know that internal controls are working, in case they are working, then you know that, okay, I think now I can believe what they're doing. If the accountant gives me this report, I can trust that because after all, I know that there are a lot of checks and balances, right? They have what is called make a checker relationship. So there's normally the person who makes, the person who approves, there is somebody who does reconciliation. So with that, there are quite a lot of controls. So I know that even on my side, the risk that we call audit risk, that is the risk that I can give a wrong conclusion, is very low, So it is very important to start by testing the controls. And after that, you go to substantive test. So substantive test is about now doing the actual calculation, performance. For example, if it is payroll, you want to take and calculate the gross pay, you do all the deductions, then you get the net, then you confirm the total, the summation at the end. So you can even get payroll for the whole staffs for a given month, then do performance. That is what we call substantive test. But of course, if you realize, for example, that controls are very weak, that means that even that payroll, you are doubting it. Probably they have what is called ghost workers in the system. And so you are actually expected to do a lot of tests. You need to test January was okay, February is okay, March is okay, because you are doubting everything. But if you realize that controls are working and a lot of strong procedures are being followed, you just do a few tests, like maybe just you pick one sample from March, you pick another one in June and September and December, then say that out of the 12 months, I've done 4. So 4 is quite a big number, that is 30%. Even in statistics, we are being told that a good sample is between 30 to 50, right? 30 to 50%. So if you pick 30% or 40, depending on the time you have, that can be good. It can give a true representation. But then that now reminds me of something, that the audit that we're doing today is not basically what we are thinking of, not just financial. We are now doing what is called risk-based audit, right? So basically, this is the end. So the history of audit itself came a long way from those old days when we just used to have somebody who was there waiting for you to do a mistake, then you explain yourself. So today, the audit is about risk. You ask yourself, this transaction has been done throughout the year, and I only have 5 days or 3 days to come and audit, to verify and give a report, say whether it is true or not. Is it enough time for me to do that? So you focus on areas of high risk. That is why when you are sampling, which we call in audit terms, we call it watching. When you are watching, you are picking some few items to represent the population so that you test those items. you need to focus on some areas of high risk. You look at the figures that are quite unique, figures that are quite huge, so that you can say, I think out of this transaction, this one appears very unique. Of course, you look at some, you have to have reasoning. Either they are quite recurring, so you feel maybe that person was paid twice or thrice, or it is unique. It is only 1 million that went, and there's nothing like 1 million again. So you ask yourself, how comes when I look at this statement, there was a deposit of 1 million that came in and left immediately? So you pick that particular item as one of the areas to do tests on. You want to look at what was the source, who sent that money, what was it meant for. So that's some of the criteria. Those are some of the criteria that you can use when you are watching. Yeah, so those are the samples that those are things that you need to test. You look at the materiality, you look at the uniqueness, right? And then, because for example, you look at the ledger. Ledger basically shows all the transactions that happened within the year. Then you realize that in January, February, March, a lot of transactions happen. You want to check, you can't audit everything, but then you ask yourself, now out of this ledger, I want to just pick some items randomly. So you are sampling. Now, one of the things that you look at are the materiality of the figures are there. Because of those figures that are quite material, the ones that are quite huge are of high risk. You can't forget them. Let's say that this company, like now NTC, we are expecting something like 3,500. That is the amount that students pay. So as an auditor, he knows, because he understands the nature of our business, akiona 3,500 haezi uliza, he knows that that is what is expected. Lakini akiona tu pesa imeingia, the rest are 3,500, lakini kuna ka 500 imeingia, 500,000. He should pick this and ask me, Mr. Dennis, how comes this 500 came? There is no school fee that can be worth this amount. So whenever this amount comes, it could be fraud. And that is also part of your topic, part of your syllabus, the fraud and money laundering. It could be somebody who has given me some money from NYS. Then I pass it through this account, withdrew it, and use it somewhere else. So as an auditor, you need to be very skeptical and ask yourself, how comes this one is quite material as unexpected? And that is why when you are going to open a bank account, they normally ask you, how much is your turnover? How much is your revenue per month? The one that you expect. Basically, they are trying to test their level of risk and trying to know the client, so that when they see 500, they don't question, that is what you expect. But in a situation where your amount is only 300, 30,000, 20, 10, and then at some point you push a good amount of money, that will be something that is red alert. Number two, uniqueness of transaction. When you look at the ledgers, probably, you will see that this client normally comes in. He has customers who normally pay maybe rent, his account for rent, and so we expect rent to be 20,000 monthly. But then we are seeing that in a certain month, there was so much that came in or left. So you ask yourself, what we expect is only 20,000 per month. If I see 20, 3 times in a month or 4 times, what could be the problem? Does it mean that that person forgot and paid you 2 times? Or you forgot and paid somebody 3 times? So again, that is what you use. So you look at the frequency of transactions, right? If the trend is quite unique, then you can also pick that particular amount. Then there are also transactions that pass only once. Throughout these, you can see some are very making sense. There are quite a number of transactions that are the same, but there is only one that came in once and has never come back. Maybe you decided at some point you want to pay your supplier good amount. You have colluded with the supplier. Unamwambia, you can just come and write some invoice. We are going to pay you. I'm the one in charge. Alafu nakupitisha hii amount. So when I look at that amount, I'm seeing that from JM, there is only one transaction that came. JM Limited was only paid once, 50,000. Which contract, what was he supplying that he only supplied once? Are you getting me, Jose? Na pata kampuni inaitwa JM that you only paid in March or in December, but you only paid him once, 50,000 or 100. He has never appeared in your ledger again. That is also a question mark. What was he supplying? Is he even part of your suppliers in the list that were approved? Those are the things that I ask myself as I do the audit. So those are the unique transactions that we're looking at. But then let's now go back to what separates assurance and non-assurance engagement? Audit is just one type of engagement, and that is assurance. So what we understand, topic number 1 in your level is called assurance and non-assurance engagement. So what does it mean? Let's go back there. So the word assure basically means to raise some level of confidence, to assure. If somebody tells you to say, I can assure you, is actually raising your level of confidence, all right? But then non-assurance is where you are not expected to raise any level of confidence. What does that mean? An engagement where you're expected to give a report or a conclusion that is intended to raise some level of confidence of the user of that information, that is an assurance engagement. That is an assurance engagement where the kind of report that you're expected to give or conclusion is going to increase or raise the level of confidence of the user of that information, the person that you are trying to give that report. He needs to believe in you. So that is called assurance engagement. So definition is basically that assurance engagement are engagements where the practitioner are expected to give a conclusion that raises the level of confidence of the user. The professional or the auditor needs to give a report that is expected to raise the level of confidence. And then this one, there is no conclusion like that. You're not expected to give any conclusion that assures somebody, that raises the level of confidence. That is basically the definition. So in engagement, we say that engagement are basically contracts, just like marriage. It is an engagement, right? So this particular contract that you're going to have with your client, which we call audit, or any non-assurance engagement, they are also expectation. If one of the expectations is to raise level of confidence, then that kind of engagement is assurance, all right? So what are types of this assurance that we're talking about? You know, apart from audit, we also have other engagements. We also have other contracts that you can do as a professional. When I talk about professional here, I'm talking about an accountant. I'm talking about an accountant. Just 1 minute, let me open for somebody. There's a teacher at the door. Let me just open for him 1 minute. Now, thank you for being patient. Now, let's look at examples of these assignments where you're expected to give assurance services, where you're expected to raise the level of confidence. So examples of assurance engagement. Number 1 is the common one, that is the audit. Sometimes we call it audit of the historical, audit of historical, financial information. Number 2, we have system assessment. Or audit. So I know the first one is the normal audit that you know, but the second one is the audit of the system. You are trying to check whether the system meets the purpose. Because when you install a system, that system should not give you more trouble than benefit. You need to ask yourself, am I actually getting the benefit? Is it meeting the objective? So again, you're going to give a conclusion to the users of the system that this system is okay or not okay, and they will believe in you. So it is also an assurance engagement. We also have compliance audit. we have compliance audit, and there are quite a number that you can look at later. Now, what are the examples of non-assurance? I just want you to understand the differences. Number 4 here, I can add you, is called review engagement. So compliance is basically, you are trying to check whether this person is complying to certain regulatory requirements or standards. That is compliance. So again, you are going to give an opinion that yes, he's complying or not, right? But then we talk about review engagement. This is an engagement that just look like an audit. Review and audit are just neighbors. They are like brothers. The only difference is the scope. In a review, ni kupitia tu, you are not going deeply. So you realize that the scope is quite limited. You are limited to some extent, right? But in audit, you do full audit, right? There is no limitation in terms of the scope. You are expected to do everything. So that is basically the difference. Otherwise, they are the same. Now, at your place of work, your manager can tell you, let me review that report before you send it. The manager is not trying to check how you perform everything, like coming to the system, looking at everything. No, an APTA is just going through it roughly. That is what we call review, right? So there is also an engagement like that. It is also under assurance engagement. Somebody can prepare financial statement and ask you, kindly come and review for me and tell me if it is okay. You are going to give a conclusion that is okay or not. One thing is, you need to know the difference between this and this. This one, because you didn't do a good job here, you are limited in terms of the scope. You give what is called limited assurance. You are not going to assure somebody fully, because even you know very well that you didn't do full job. So you can't give 100% or even a higher level of confidence. So the level of confidence here is quite low compared to this. Number 2, the assurance here is limited, but this one is full, or you can say reasonable. Reasonable, it makes sense, it's quite high. So this one is reasonable assurance, this one is limited assurance, right? The scope here is limited, the scope here is unlimited. The risk on the side of the auditor, when you're giving conclusion, the risk here is quite low because you have the opportunity to look at things clearly at a good time, good scope. So the risk is quite low on the side of the auditor. He's giving a conclusion from an informed perspective, But here, the risk is quite high because even himself, the auditor, is giving a conclusion where he didn't have the opportunity to check everything. He was actually limited to some extent. So again, the risk here is quite high. It's quite high on the side of the auditor. He's taking a higher risk by giving a report that is not even sure of 100%. In exam, they can ask you, give us the differences between assurance, give us the difference between audit and review engagement. Audit engagement and review engagement. Those are some of the differences that you can still get in our notes. I'll share notes with those who will be in our classes, right? So now that you have seen some of this, let's look at non-assurance engagement. Examples of non-assurance engagement. These engagements where the practitioner is not expected to give any conclusion. You're not expected to give any conclusion. Yani unakuja, unachapa kazi yako ukienda. You just do the job and go home. You are not expected to raise any level of confidence, to say the truth. No. So that is called non-assurance engagement. So let's look at the examples. Non-assurance engagement. So just look at one, it's called Compilation Report. Number 2, we have one that is called Agreed Upon Procedures. Number 3, we have Bookkeeping. Number 4, we have tax returns or tax return services. Number 5, management advisory. management advisory report. In these ones, these are examples of assurance or of non-assurances. I hope you can see very well. So the last one is management advisory. We have tax returns, we have bookkeeping, we have agreed upon procedure, and then we have compilation report. The first one is called compilation report. Compilation report. Are we together? Is there any question up to there? You need to ask questions because your neighbors are quite fearful. They don't like speaking. So if you don't talk on their behalf, they will not actually say anything. They won't actually say anything. So these are things that you need to know. Compilation report. When you talk about compilation report, what are we talking about? Compilation report are a situation where the accountant has done his work, but he's telling you that, Mr. Dennis, I don't know how to prepare financial statements to appear like the ones that are audited. Ushaona zile ziko drafted. So it is about drafting, where you can draft so that we can see that this one is the profit and loss, these ones are the balance sheet items. Now, the one that looks good, then that is what we call compilation. You are just compiling them, bringing them together. In this particular one, you are not trying to investigate anything at all. So you are not going to give conclusion anywhere. You are only compiling and giving him the draft the way it is. So it is just basically about drafting reports to be able to show what profit and loss items are at the balance sheet. You don't know whether those figures are accurate, you don't know, and you don't care. Number two, we have agreed upon procedure. Just from the word agreed, they are agreeing about a certain procedure. So we have two parties here. We have the client and we have the auditor. They are agreeing upon a procedure. They are saying, let's follow this procedure. This is how I want my financial statement to look like. You are not following the ISA standards, the procedures that you're expected to use in audit. You are not following this. When you follow this, then you are doing audit because this is the standard for auditing, international standard for auditing. But then you are following a procedure that you have agreed with the client. So that is something else. The client cannot tell you after following his procedure. He's telling you, because already you have deviated from this, he's telling you to say whether the financial statements are true or not. That is wrong. It can never, right? Then we have bookkeeping, the normal accountancy. If you are doing this service to somebody, you are not caring, you don't even care whether those figures are true or not. Well, umepewa hivi evidence, punch in. So umepewa papers. These are the receipts. Unaweka tu. Whether they were forged, whether they are fake, whether they are original, you don't care. Your work is only umepewa receipt, punch in. Then you go home, right? Then we have tax return services. This is where you are filing for somebody monthly return, VAT. You are not checking whether those VATs are accurate. Your work is only, these are the income tax, or maybe the VATs, you look at the input, output, your work is done, right? So again, you are not expected to give any conclusion. Then we have management account, where we're going to give management reports, the account to the managers or their company. You are only trying to do just like normal accounting. We have management accountants. They'll give those reports, let them go and make their own decision on the other side. So is there any question here? In exam, they can ask you to give examples of non-assurance services, right? Give example of non-assurance services. These are the ones that we need to look at. Now, I'm waiting for somebody to give a comment or even a question so that I know that you guys are here. Maybe somebody is busy cooking and I'm here making noise. I need a question. 1 minute, I'm giving you 1 minute to raise a question or at least a comment. Kindly following and understanding. Thank you very much. Any other person? Any question? Or keenly, sorry. Okay, let's look at what is now called elements of assurance engagement. So far, you are good. Thank you very much. And I hope you are going to subscribe so that we continue. Remember, as per our timetable today, we have audit. We normally have audit today as per our timetable. So you can subscribe so that we go together. The good thing is we do a topic by topic as we revise. So this one is the first topic under your level, all right? This one is the first topic, assurance and assurance engagement, and these are the contents. So let's look at the elements of assurance engagement. So sometimes to make it easier, I tell students that elements are basically characteristics, yani tabia. Ukiangalia hivi, unasema huyu anakaa hivi. So what can separate assurance engagement from non-assurance? What are some of the things that you need to look at? In examining, they ask to differentiate or give us the differences between assurance and non-assurance engagement. Then one of the points that you need to look at are the elements from the elements. So number one, for us to have assurance engagement, there must be three people. There must be three people. So we say third-party relationship. That's the first point. Third party or three-party relationship. And who are these three people? The first person that I know is the practitioner. That is the auditor. The second person that I know must be there is a responsible party. That is the person who keeps the book. He's the one who keeps the subject matter. I say that the subject matter is what is being audited, right? Now the person who takes care of that, hata nyumbani tukuna caretakers, ndio, that caretaker, which in this case they are managements. So it is called a responsible party. Then we have number three. Number three, we have a user of the information, users. So these are the three people that we're talking about. Now, responsible party, in some cases, they can be the same person as the user of the information, but in most cases, they are different. So in this case, I'm assuming that they are different. In a situation where you're auditing, for example, a bank, we have staffs, employees. They are expected to keep the subject matter. They keep the financials very accurate, safe, and the assets of the company safe. But then we have the users or the owners. These are the people who are interested in the financial information. They are the people who want to use the financial information. Most of them are board directors, the managements themselves. We have the shareholders who have invested there. So who are the users? The users can be number one, employees mwenyewe. Number two, we have governance, that is the board of directors. Sometimes we call them governance. We have government. Government requires this because of tax. They want to see the financial statements. They wajue how the economy is doing. They can make policies. Also, they can also tax appropriately. So they need this. So we need government agencies. We have investors who are going to rely on this report to be able to make a good financial decision on whether to invest or not. So we have investors. We have suppliers. Of course, suppliers are very concerned with the report. They want to know whether this company has issues with going concern. Yani kampuni haitaendelea for the next 12 months. They want to be sure that if they supply anything on daily, they can be paid. So those are suppliers. We also have creditors like banks. I'm not just saying that this one must be a bank, but we also have other creditors. Even a bank get money from other banks, right? Or any other company. So we have those people who normally give them. So the creditors, or we call them, are they lenders? Or we call them creditors? I don't know the right word or whatever one that you want to use. Let me call them creditors. I believe so. We also have, apart from this, who else do you think wants to use this information? Potential employees. hata wewe unataka kampuni yenye inafanya vizuri. You are very proud when your company is doing well, ndio? And as a potential staff like me, if I want to apply, if you give me two companies, one is doing well, one is doing poorly, I will not want to associate myself with a company that is not doing well, right? So potential employees are also looking at the financial statement, right? So we have seen investors we have there, and so many other users that we can look at. They are also part of your notes. You'll be able to look at that and be able to share that, right? Then, so this one was just one of the characteristics that we need to have three-party relationship. Number two, the second characteristics, and of course you've seen the three parties. Number two, we need to have subject matter. And so we are saying it needs to be appropriate. Appropriate subject matter. What do I mean by appropriate? It is something that you can easily identify and it exists, all right? You can't call me to go and audit something that I cannot easily identify and know that it is this one, na COE, number one. That subject matter should also be appropriate in such a way that it has standard. It can be examined or compared with certain standards. Because the audit is basically about having the standard here, comparing with the subject matter here. So if the subject matter is something that does not have any standard to be compared with, then what are you auditing? How do you know whether it is wrong or right? So we need to have appropriate subject matter. Then we need to have, number four, you need to have suitable criteria. Suitable criteria. So we need to have a standard. This is basically the standard. This is the standard that we're using to compare with the subject matter. If you are auditing financial statement and you are saying that they are not according to the standards that are required. For example, if it is about PPE, we need to check whether it is according to the required standard. If it is about maybe revenues, recognition of revenues, maybe we are talking about IFRS 15. We need to check that IFRS 16 is actually in line with the financials are in line with the IFRS 16. And if I'm talking about impairment, I need to check that IFRS 9 is actually being applied. So those are the standards or criteria. Then we have number four, evidence. We talk about sufficient evidence. Sufficient and appropriate evidence. Now, the most important thing here is evidence. Everything that you're doing here, you must attach something to support so that at the end of the day, you say that, okay, I was able to check the subject matter. It is not in line with the criteria. And this is the evidence that I have. This is the criteria. This is the subject matter. I was able to check, but they are not in line. And I can quote or I can attach evidence. I can table evidence. So that is very important. When we talk about sufficiency, we're looking in terms of the quantity or the evidence. You can't go with something that is quite small. You are saying that this one is the evidence that I have. For example, you might be auditing bank balances. Then you realize that in the bank balances, we have maybe something like 100,000. At the close of the year, cash and cash equivalent was 100,000. Then after doing audit, you realize that 1,000 was lost in January. So you go to the board saying that I have evidence that the accountant is stealing. This is a proof. This is the proof that 1,000 got lost. That is quite insignificant. That is what we're talking about. When you're looking at the evidence, look at the sufficiency in terms of quantity. Bring something that is worth sitting down to discuss with the board. Remember, you're going to present your report to the board members who are quite senior people. You can discuss something that is quite immaterial. When you talk about appropriateness, we are talking about relevance. In fact, I can talk about the quality. So here, sorry, not relevant, not appropriateness, but relevant. Relevant evidence. So it is sufficient and relevant evidence. That evidence should be relevant to the subject matter. And here, we are talking about quality. And so in exam, they might not ask you to state or give elements of assurance and engagement, but they can ask you, what do you consider to be a quality or a relevant, or a good evidence. They can use any term, relevant, quality, or good evidence. So there are some features that you need to check. For example, when you look at evidence, which one do you think is a good evidence? All right. So let's look at number 5. Then I can tell you something about evidence. So number 5 is the report, audit report. This is the last thing, a report or conclusion report. So when you look at these characteristics, most of them do not appear in assurance engagement. Most of them do not appear. In an assurance engagement, you don't even worry about suitable criteria. All right? You're doing compilation report, right? Or agreed upon procedure. Then we have sufficient evidence. You're not even expected to attach any evidence. You are only doing as per the agreement. You don't even look at the sufficiency, the relevantness of the evidence. No, doesn't matter. Then under report, you are not expected to give a report that has conclusion. So the differences that you can pick from here between assurance and non-assurance engagement. Number 1, it does not have three-party relation. There is no three-party relation in non-assurance engagement. Because in assurance engagement, we have the auditor, we have the user, and we have the responsible party. In an assurance, like for example, bookkeeping, you only have the management who is lazy and has asked you to help him, and yourself. There is no any other person outside there expecting to use that report. In fact, they don't even know it. Only this person, maybe they have less staff or is lazy, is telling you, come and do for me this job. There are only 2 people. So you don't expect 3-party at the government and a concern anataka kuangalia hiyo report yako vile umecompile. No. You don't even have investors looking at your report, right? But for assurance engagement like audit, those people are so interested. But tax return, you only have the responsible party and yourself. The responsible party will give you, help me. So again, this characteristic is not applicable. So in exam, you'll try to understand these ones, then you now relate it with the question that you're asked. But let's now look at the relevance or a good evidence. What are some of the qualities of a good evidence? Number 1, a good evidence is evidence that you get from the original document. For example, if it is logbook, if somebody is telling you that, I have a car and is giving you logbook, photocopy of the logbook as the evidence, you cannot be sure whether he has sold the car and even transferred and gave out the logbook, the original. Now I'm back in a copy out at you. So if you depend on the copy, you are actually depending on the wrong thing. You need to have to see the original evidence, original documentation. Number 2, a good evidence is the evidence that is documented down. Let somebody not tell you things on theory. What is the proof? That is why in most cases in court, unaambiwa andika chini. Hata ni witness statement. Utaandika statement yako, ndio uende useme tena kotini. But everything that is important in your life, everything that is important, things like buying land, things like buying motor vehicle, there is normally agreement written down. Things like marriage, there is normally certificate. Kama una enda utafute. Because when things go to court, you will not have any evidence and say that I can prove this is my wife or this is my husband. So the same with this case. A good evidence, the one that you can see in documentation. So it's normally documented. So a good evidence is the one that is documented evidence. Documented evidence. Those normal ones, achana nayo. Those ones, there is no proof. In fact, nitasema sahi, ukinipeleka kotini nasema sikusema hii, nilisema hivi, right? You've seen what politicians normally say. Anasema sikusema hii, sikusema washa taa. Nilisema wacha sawa, wacha taa, sio washa taa. So that is what they do. Another good evidence is the one that is collected by the auditor himself. the auditor is able to see. So if it is observed by the auditor, not any other third party, that is also a good evidence. I normally call auditors practitioner. And I like this one. I normally tell people that when somebody tells you that you see Nani is lying, what is the proof? Asikwambie, now you take action with rumors. Always once follow up and see. Ukiona wewe mwenyewe, you are the auditor, then that is evidence. Those other things are rumors. Ati unajua nilimuona, alikuwa hapa, walikuwa hivi. Those are rumors until you see it. As an auditor, a good evidence is the one that you observe. The fourth one, a good evidence is the evidence that is generated from the client system by the auditor. The auditor collected directly from the client system, generated directly by the auditor. The one that is generated directly from the client system by the auditor. Yani the auditor has performed the test. Amechukua computer hivi, aka log in kwa system, alafu akapata hiyo report yeye mwenyewe. That is a good evidence. He has generated directly from the system. The auditor has generated directly from the system. That is a good evidence, especially where the internal controls are working. If the internal controls are not working, then even if he generates anything, that anything might also be wrong, might also have some errors. So we are saying a good evidence is the one that is generated directly from the class system by the auditor, where the internal controls are also working. Because that means that even errors are also quite limited. So that is a good evidence, right? Any other person who wants to try and tell me what a good evidence is? Let me see those who are with me. What do you think can be a good evidence? What can you consider to be a good evidence? The last one. A good evidence is the one that is obtained from independent source outside the company. Independent source. Independent source outside the entity, right? So what we are saying here, if you get evidence from third party who is independent, who is not influenced by anything, that can be a good evidence. For example, today, if you go to the bank and ask the bank to tell you my account balance, the bank will tell you the truth if you are given that authority. Lakini ukiniuliza mimi nitaanza kuenda hivi. So the best evidence is the one that is given by a third party who has the information, but that third party does not have any influence, is not under any influence at all. So why is it a good evidence? On how can we apply this? When we'll be doing a lot of our work here, you'll be able to see that some of the ways in which you get your audit evidence is when you send circularization. You send a letter to your client or your client's customer. Unamuuliza, how much do you owe Mr. So-and-so? Why? Because he has shown that under his receivable, he's expecting to receive this much from you. Is it true that you owe him this? So if that person is independent, he will tell you the truth that no, I owe Mr. So-and-so, who is your client, I owe him only 10 million and not 12. And he can support that. Then that is a good evidence. That person doesn't have any interest in the report. He will say nothing but the truth. So. Then now, last part that I want us to look at, then we can close this. It was a free class, but it was our first class for the year or for the semester. I want us to look at the types or levels of assurance engagement. We have levels of assurance engagement. Any question here, what we've covered today so far? Any question on what we've covered today so far? Independent third party, yes. Independent third party. That is the right person. independent third party. If that third party is independent, cannot be influenced by your client that you're auditing, then that is a good evidence. So let's look at the types of assurance engagement. The other one, we are looking at examples of assurance engagement. Zile zingine, they were not types. They were examples of assurance engagement. Now I'm looking at the types of assurance engagement. So assurance engagements are normally classified under two categories. The first one is hazard assurance level. This is the first category. Under this level, we have limited assurance. Then we have a reasonable assurance. Now, I think I've explained something about limited assurance. We say that this one is where you have limitation in terms of the scope. So this one, the practitioner has limitations of scope, right? So you can't be able to give full confirmation. But under reasonable assurance, you have unlimited scope. So there is a positive form of expression in this one. You always express yourself positively with confidence and say, according to me, this is the financial statement. This is what the financial statement is. For example, that is called positive. You can say that, in my opinion, the financial statement represents true and fair view. I am quite positive. I've been able to audit. I can give a direct opinion. So I own it, in my opinion. That is called positive expression. Positive expression here. Positive expression. But here we give negative expression, where you are saying, you are not saying that in your opinion, no. In negative, you only say that nothing has come to my attention. Nothing has come to my attention to show that there are errors. Nothing has come to my attention to show that there are errors. But you are not telling us whether, according to you, there is no error. You are not telling us that. So we are saying, unajificha, because you are not very confident, because you didn't do a good job. You are limited, you are having some limitation in terms of scope. So unaogopa, unajificha. So you say nothing has come to your attention, but you're not telling us what came to your attention. What came to your attention? Did you really confirm that there is no error? You're not telling us. You're only saying that you have not been able to see any error. So that is what we call negative expression, where you say, in this case, the level of confidence is quite low, the higher audit risk, and the expression is negative, where you are saying nothing has come to your attention to show that there's a financial misstatement. All right. So those are an engagement. So you can find yourself an engagement which is assurance in nature, but according to that engagement, the level of assurance differs. In one, the level is quite limited. In another one, the level is quite high. Those are all engagements, and they are assurance engagement, but the levels are different. In the second category, we have a level that is called as at structural level, as at structural or structure, yani the arrangement. With your contract equal arranged, so structure level. So under this, we normally have as an attestation, or we call it assertion. Engagement. Then we have direct engagement. I'm not sure if everyone is seeing that. Let me check if the board is able to cover that, whether you can be able to see that. Yes. So we are talking about, the first one was under assurance level, where we have limited and reasonable. We say that under limited, we are giving what is called negative expression, where you are saying that according to you, nothing has come to your attention to show that the financial statement will be materially misstated, meaning that you are not telling us whether, according to you, they are okay. Unajua ukiuliza mtu kitu, inafaa kuambie directly. Unamuuliza, did you go to school? You don't say that, I'm not very sure, no. It is either alienda or not, right? Because you should know, right? So in this case, you don't need to feature even kidogo. Just say the financial statement represent true and fair view or not. In this case, this person is not very confident because of the limitation in scope. He did do a good job. So he's saying nothing has come to his attention to show that the financial statements are true or not. In this one, he's saying he's very confident because the kind of work that he did, he's very confident with it. He was enough and he can actually defend himself. So he's saying, according to me, the financial statements represent true and fair view. That is called positive expression. And the reasons why they are giving positive or negative, you know, in the limitation of scope, that is the main issue. An example of limited assurance engagement with state, we talked about review engagement. And then example of this, we talked about audit of financial statement, audit of financial statement. They might ask you an exam, differentiate between the two, at least now you know. Limitation of scope, expression of opinion, and of course, the last one is the risk. In terms of the risk is quite higher here than this one. Risk is quite high here than this. Welcome. Yes, thank you for coming in. Now, under this category that is called at a structural level or at structure level, we are having an engagement where the structure of the or the arrangement of that particular engagement differs. In the attestation engagement, this one, the first one, we call it attestation or assertion. This is where the responsible party, which is the management, who is supposed to keep the books and call you to audit, has decided to do audit himself. So it's the one who is going to do the assessment, is going to collect the evidence, is going to write report, and only comes to you as an auditor to give your opinion. Yani amefanya kila kitu. He has done investigation, he has done assessment, he has done, collected all the evidence, all right? He has even written the report. He's only coming to tell you, kindly look at this and tell us your opinion. That is called attestation or assertion. In this particular one, direct engagement, the auditor himself is directly involved. Is the one who is going to perform all that, right? He's going to perform all the audit tests, he's going to collect evidence, perform the evaluation and everything, then give report, right? So he's directly involved. Let's stop from there. Thank you very much. Our number still remains. If you find our numbers, they still remain the same way they were, right? So you can get in touch with us through 0705 for more classes, 0705 735 103 or 0726 83 9808. So call us through that, make your payment. We only charge 10,500 until exam, including blocks. But in case you connect 1,000 or you only have less than 35, you can do the deposit. We allow installment. You can do installments. So Kelvin is saying that don't understand differences between review and attestation. Review. I've not talked about review. Attestation is where somebody is going to give, the responsible party is going to perform all the audit procedures. You only come in to give conclusion. But review, ni kupitia tu, right? He's going to, maybe he has not even done the audit. He has only drafted. So that is the difference. In review, somebody could have just drafted, you are only going to pass through it. But in the other one, under attestation, you are going to, he has done the audit on your behalf. He even has the evidence, he has done the full audit. You are only coming to give a conclusion, your opinion. So they are quite different. So let's start from there. Our next class, as per the timetable, you'll be able to get it. As per the timetable, I think we have a class. The next audit class is tomorrow. Yeah, we have a class tomorrow. So let's meet. You can pay so that we meet tomorrow in class. Thank you very much. Have a good night.